We just have a quick question, you guys, from Mazia, who is asking about something he read in a recent ING article, where ING referred to the implied euro yields via the 3-month forward. So what the bank said was that the implied euro yields via the 3-month forwards are now negative 0.7% and makes the euro a preferred funding currency. So Mazia just wants a little bit more clarification on what exactly the bank, what they mean with this statement. So thanks for the question, Mazia. I think it'll be useful to start with the difference between spot rates and forward rates, and then take it from there. So as you know, spot rates, if we just quickly open up the major pairs for a second, spot rates are just the current exchange rate for any given pair at any given moment, right? It's the current price right now. For example, euro dollar trading at 116.33, that's the spot rate. Dollar Swiss franc trading at 0.9227, that's the spot rate. So it's just the actual rate. Now, apart from the spot price, you sometimes also have options pricing for a particular currency pair, which gives traders the option, but of course not the obligation, to buy or sell a particular currency for a particular price at a particular time. And for you to have the option to transact at that price at that specific time, you obviously need to pay a premium, an options premium. Now, then you also get something that's called a forward rate. And the difference between a forward rate and an option, remember, the option just gives you the option to transact or to buy or sell a particular pair at a particular time at a particular price. Just gives you the option. Where when it comes to something like a forward rate is not an option to buy or sell. It's actually an obligation. You enter into a contract. You're obliged to buy or sell that currency at that specific price, or exchange at that particular price in the future. So it's not like an option where you have an option to buy or sell. It's actually a contract, an obligation to transact. So I always pull it back to what it means for in the real world for companies, right? So think about a forward rate in connection with a company. Let's say that you own a company in the UK and you need to sell £1 million in order to exchange for euros in the next couple of months. Let's say it's for a contract, or you need to buy equipment, or it's whatever the reason is for your company to transact in the next 3 months. Let's just use 3 months because we're talking about they were talking about the 3-month forward. So let's just say we take 3 months as a time frame, saying that in the next 3 months you've got £1 million that you'll need to exchange for euros. Now, the challenge for you with this 3-month time frame is that you only plan to do that transaction or series of transactions over the next 3 months, and that means that you run the risk. Your company runs the risk of either losing money if the exchange rate moves against you, but of course you can also make money if the exchange rate moves in your favor. Now, as a company, you're not in the game to speculate on whether the exchange rate is going to go up or down. You just want to know what's going to happen to your bottom line. And you don't want to have the risk of the exchange rate moving against you by a few percentage points, because obviously that can be very detrimental to that transaction or to that deal, etc. So you would rather want to have a fixed price at which you can exchange that £1 million over that 3-month period, or in the next 3 months. So that's where the forward contract comes in. You can enter into a weekly or a monthly or 2 month or 3 month, etc. forward contract that locks in a specific exchange rate for you, which means that you are obviously protected should the exchange rate move against you, i.e., let's say you need to exchange your £1 million into euros. If the euro gains considerable ground against the pound during that 3 months, you don't lose money because you're protected. You've got that fixed price. But it also means, of course, that you will lose out if the pound instead gains ground versus the euro during that same time frame. So to eliminate the risk of currency or exchange rate fluctuations, a company can enter into a forward contract which obliges them to exchange that £1 million into euros in that window. Let's say, just say it's 3 months. But you do it on a price that you agree on today. So if you decide that you're going to take that contract, only exchange it in 3 months, you get that fixed price that you agree on today for that forward. Now, something that's very important to understand about forward rates is that forward rates are not indicative in any way of expectations in the market. So if you take a look at this chart here, this is the forward curve for the euro dollar euro dollar forwards. It's the forward curve, or the curve chart for the forwards rather. And what you can notice is that it's moving with an upward slope. Right now, if you just look at the curve alone, it might lead you to think that the market is implying that the euro dollar is going to continue going up in the next 12 months. But that is not the case, right? This isn't there's no sentiment baked into this forward curve at all. The forward curve is simply just the current spot price, whatever it is. So currently we're trading at, what is it, 116.31. So it's just the current spot rate, with the interest rate differentials included. And that's that. So as the interest rate differentials change, so will the forward prices change. But there's a specific reason why you see this slope moving with an upward curve. So think about it from an arbitrage point of view. If you have a 3-month forward and you are dealing with a high yielding currency, let's take something like the ZAR versus the US dollar. That means that for you to have let's say no way of making risk-free money, or having an arbitrage opportunity, your positive carry currency like the ZAR, the forward rate for that currency will always show a depreciating currency, and your lower yielding currency will have a forward that will show that it is appreciating or appreciating to eliminate the chance of arbitrage. So if we change it from a ZAR to a dollar, or from dollar ZAR to something like euro dollar, like we have on this screen, in this case, you have the dollar, which is your higher yielding currency, and you've got the euro, which is your lower yielding currency. So in this euro dollar forward rate, the dollar will be trading at a discount to the euro, as there can't be any arbitrage opportunity with the higher carry with the dollar in mind. So the reason why you see the euro dollar forward curve moving higher is because the dollar is trading at a discount compared to the euro. So if you were to consider something that has a higher carry to the dollar right now, so let's take something like the pound, for example, you can see the pound forward curve chart is actually moving to the downside. The reason for that is, remember, right now gilt yields on the front end, so anything between 1 month and 1 year, gilt yields is actually higher compared to dollar yields. So they are offering a higher yield. So in that case, right now, the pound year is your higher yielding currency, with the dollar in your quote obviously being your lower yielding currency. So that means that your pound will be trading at a discount compared to the dollar, because it's the higher yielding currency in this case. So this isn't the market telling us, oh, we think, pound dollar is going lower over the next 12 months. It is purely just accounting for rate differentials and accounting for arbitrage with the spot price in mind. That's it. So what ING was referring to in their article, if we just quickly go back, what they were referring to in their article was that the implied yield between for the 3-month forward implied that the euro was a preferred funding currency. Now, personally, I wouldn't use the implied yields from forwards to reach this same conclusion, because if you just look at the rate differentials themselves, it will lead you to the exact same conclusion. So let me just show you what I mean by that. If you quickly take a look at this chart, on this chart, we've got a couple of 3-month bond yields for a couple of the major currencies. So at the bottom, we've got the Swiss franc, then we've got the Bund 3-month, we've got the Japanese 3-month, we've got the US 3-month, then we've got the Canadian 3-month, and up here we've got the pound 3-month. So you can see that very big rate differential between the US, for example, as well as the pound. So that explains that downward sloping forward curve once again. And if you take a look at the dollar or US yield versus that of the Bund yield, that explains the upward slope once again for that forward curve. Now, if you just take a look at this chart, on this chart, the euro is one of the lowest yielding currencies among the majors. It's even lower compared to the Japanese yen. So the lower the yield goes, from a major currency point of view, it's obviously going to be a preferred funding currency. That, as well as something like the Swiss franc. So again, you can see that just by looking at the yield differentials without looking at the forwards, it gives you the exact same conclusion, right? So the forwards is simply, it's just the spot price adjusted for these yields that we see on the screen. Now, do keep in mind that the yields that's used in forwards is often not the actual bond yield. It's often the deposit rates over those time frames. So there will be a difference between the forward and the actual 3-month yields differentials that you see over here. So, for example, if we take a look at the current the forward rate, let's use that 3-month once again. We can see that let's just go back to euro. So we can see that the current 3-month forward is sitting at an outright of 116.56, and it's worth about 26 points, right? So basically, spot price plus 26 points or pips. Now, if you compare this to so again, this is using the deposit rates over that time frame, right? If we go to the actual differentials right now, if you plug in the actual 3-month yield of negative 0.72 as well as the US 0.05%, if you plug that into a calculator, investing.com has one. If you plug in the current spot rate and you plug in those rate differentials, and you also look at a 3-month or a 90-day period, you'll see that it comes in at 1988. So you're about 7 pips short of the forward curve, again, because there's going to be a difference between your the actual bond yield and the deposit rate that they use being accounted for. But what you can see is that it's very close, right? It's not the difference between 1 pip and 400 pips, for example. It's a very, very tight range. So that's why, in my opinion, using forwards to reach this conclusion is just the long way around. If you just have access to a trading view chart and you plot in the different bond yields, obviously you can get to that similar conclusion, in my opinion, much more simply than using something like forwards. Forwards can be very confusing, but always just think about it. If you look at a forward rate, just think of the forward rate as it's my spot price plus what the markets plus the rate differentials between those two currencies. And then obviously accounting for that over the curve means that your base currency or your higher yielding currency will be trading at a discount compared to your lower yielding currency. And that's why you have that upward sloping yield forward curve, or you have that downward sloping forward curve. If you compare the dollar yen, for example, in the dollar yen, you've got your dollar as your base, you've got your yen as your quote, but obviously your dollar in that case has the higher yield. So compare, a pound dollar to something like dollar yen, you'll see that same downward slope again, because the dollar here has a higher yield compared to that of the Japanese yen. So it's not implying that dollar yen is moving lower. It's just accounting for rate differentials, as well as making sure that there's no arbitrage opportunity between them. But again, looking at these curves, looking at forward rates, it can be a little bit confusing sometimes, which means that just looking at this, a lot easier to get to that same conclusion. So euro, a preferred funding currency, purely just based on that massive gap between even something like the Japanese yen. So I hope that helps, Maziar.